and we'll begin with Stefan Seo.
Thank you, Jonathan. I will now cover the $2 trillion relief bill that was just passed by the Senate. And this is an important topic to cover and understand, as it will play a critical role during this historic time. And some argue that this bill will not be effective because it is not possible to create wealth by creating cash out of a thin air, and money cannot combat a virus. And part of this argument does make sense, as a country's wealth is not defined by the amount of cash. Think any country with hyperinflation, such as Venezuela. But a country's stability then are related to its rules and a robust functioning society and a stable currency. And given that we're in a time where most people cannot work, this is a lifeline to keep the economy going. And so that's why we want to cover the $2 trillion Senate coronavirus bill first. And with that being said, I will share now a screen. So this is the largest stimulus package in American history. And this part will go over the high-level overview. So $301 billion in direct payment to households, $349 billion in loans to small businesses, which is critical given that small businesses make up a huge percentage of the US economy, and $500 billion for loans. And this is really directed at mostly large corporations, and also $250 billion to make up unemployment insurance as well. Now, going back to the households, how will this work? It will be more or less direct payments to individuals, and you can see some of the details here. There'll be about $1,200 to adults per individual, and also $500 per child. And it will be structured as tax refunds. And this is critical because this is a mechanism to provide money to those in need as quickly as possible. And it really starts at $75K of individual income, and it starts phasing out from there. And then how will it work for large corporations? Now, this includes the possibility within the bill that governments can take direct ownership into those companies that are in need. And some of the more interesting parts that are in there are those businesses or companies that are critical to deem to the national security, such as Boeing. They will get direct financing as well. And the remaining portion of that bill, about $450 billion, will go towards the Federal Reserve to see how they see fit. And then for small businesses, this is critical. So these are some of the specific rules that are for small businesses. The loans have been vastly expanded. So we are able to help if anyone's in need, and really undergo and study which type of small businesses will be able to take advantage of this type of loan. And two quick other slides that I think are interesting. It's really impossible to say how quickly we will rebound. There's a lot of speculation out there, but these are some of the details. As you can see here, the property sales are almost going back to normal in China. So obviously you could see a huge dip. China was hit first in January timeframe, but as months passed, and now in March, late March, you could see the blue line really returning back to the averages of the past few years. And then on a lighter note, as you could see here, the traffic is also starting to normalize. So as you can see, back in January, it was very, very low. And now more people are moving around. And again, this is not to speculate when the economy will be back to normal, but perhaps with the stimulus that the US has, nearly about $2 trillion, the economy can come back sooner than a lot of people are predicting right now. Thank you, Jonathan. So that was the overview and the stimulus package.
Thank you very much, Stefan. Before we introduce Mark Peterson of BlackRock, I'm going to, my father and I are going to share a quick discussion on what you can be doing in proactively from a tax planning perspective during this time. So, you know, because people feel like, I think a lot of people, this is an opportune time for many people. One of the things we can be doing during this time is Roth conversions. And they tend to do really well for a lot of people. So the two ingredients to do a Roth conversion is a low income year from a tax perspective, as well as a depreciated asset that will ultimately grow over time. So if this is a year when you've got less income because of the economy, and the value of the assets in your IRA have grown, you can go ahead and distribute it out of your IRA, put it into a Roth, pay tax on the value now, which is depreciated, presumably, at a rate which is lower because the economy is tough, presumably, put it into your Roth and let it grow there indefinitely, tax-free. So for a lot of clients, that's a really, really great tax strategy, and I want you to be aware of that. The other thing that's very interesting, the other thing that is going on now is that you can fund your pensions now. Now may be an opportune time to fund your pensions, which you otherwise would have funded later in the year. Okay, so funding your pension now may be a really great opportunity. So generally, a lot of businesses fund their pensions in September or October, concurrent with the tax filing. But now may be a great time to put the money into the pension while values are low, as we expect a rebound over the coming months. So funding the pension is a second item which many clients may want to do from a tax planning perspective. Of course, tax loss harvesting is a wonderful strategy at a time like this. And I want to introduce that concept by explaining a little bit in what that is. There are many, many investments which have similar economic exposure, but are technically different. I'll give you two examples so you can own this and really understand this. The first example is Berkshire Hathaway. You've got an A share and a B share, which are almost identical in every single respect, except the denomination in which they trade and some technical differences. Well, suppose you made an investment in the S&P, or another great example is the S&P 500. The S&P 500 can be bought in probably 30 different flavors. Every fund company has their own variety of an S&P 500 version. And what you can do is swap one for the other, realizing a tax loss while maintaining the same economic position. So suppose you entered the S&P 500 at $100 a share, and it now drops to 50. You can swap from one version to another, taking the loss, putting that in your pocket, and riding the rebound in the alternative version. And what you've done is maintain the same economic position, but taken advantage of the tax loss. And the fourth thing I want to talk to you about before I hand it over to my father is out-of-state trusts, which is something we've been discussing for some time, particularly for those clients in high income tax states like California and New York. And in doing, one can use what's called a completed gift trust, where you take an asset, gift it to a trust out of state, and allow that trust to grow out of state and economically. And that works particularly well now when values are low. So suppose you had a $10 million asset or a pool of assets, a brokerage account, and it's now dropped by 25%. If you had transferred that asset at a valuation of $10 million, you would have needed to report that and use $10 million of exemption in moving that trust out of state using a completed gift trust. Well, now with values being off 20 or 25% from their highs, some cases more, depending on what the asset is, you only would have to use, say, 7.5 million instead of the 10 million of exemption. And so now you've moved a $7.5 million asset out of your estate and out of your state, both, into an out-of-state completed gift trust, and you'll let it rebound and grow there, thereby avoiding state income tax for years to come. That strategy only works with assets that don't physically have nexus to the state in which you're in. So either a business or real estate would not work, but for a brokerage account, it works very, very well. With those four ideas, Roth conversions, funding pensions now while values are low, tax loss harvesting, and of course, out-of-state trusts, I'm going to turn it over to my father. Thank you.
Thank you, Jonathan. I hope I'm on and can be heard. I don't think I can be seen because of the technology issue which we're facing. But I wanted to deal with a couple of tax and estate planning ideas, taking advantage right now of several key issues. Number one, we have obviously depressed values, and we want to take advantage of those. The second thing we have is a soon to expire exemption of roughly $23 million for a couple. And so, and there will be an exemption from estate tax. For those who are in a significant estate tax position, We now have a very special opportunity to take advantage of both of those. And I'm going to cover a few of them, but I want to just preface by saying just a step back on the market, where we are and what's going on. All of you know that the bill is now being passed for a $2 trillion, as Stefan had said, $2 trillion adrenaline injection into the economy. Interestingly, overnight, the unemployment results came out, and we have huge unemployment, significantly higher than was expected. And yet the market is strong today, which proves the thesis which many hold, that the market can handle almost anything except uncertainty, even even bad news. By starting with that, by saying that we're now at least within visibility of the end of the lockdown, and Trump is targeting Easter, which will have left us with probably between 2 and 3.5 weeks of lockdown, depending on when you started and where it started. At least the concept that the beginning of the end is now visible, I think, is having a significant impact, and hopefully that will continue. Of course, we're not forecasters, but the tea leaves are fairly clear now that the government is going to do whatever it needs to do to salvage this economy, and it's already demonstrated that interest and has indicated an ongoing willingness to do so. In fact, yesterday I was informed that all bank deposits are now fully FDIC insured, even small banks and so on. So those of us who were concerned about possibly being with a quote-unquote small bank, apparently this kind of satisfies that fear. I think they were worried about a rush out of small banks, and the FDIC stepped in and said full insurance. Obviously, you should check this before you act on it, but it's pretty good news in terms of instilling confidence. Going through some of the tax planning ideas that we wanted to mention, and this isn't, of course, an estate planning or tax planning presentation. Our goal here is to highlight opportunities and pitfalls for further investigation. One of the things we're always very interested in is something called a charitable lead trust. We had a client who had a very concentrated position in a particular public company, came on board to us, and it was a very significant holding of his. He didn't want to be concentrated in one company. And of course, in hindsight, that turns out to have been a pretty good position, and one that we advocate. One of our core principles is diversification. And so what we did is we set up a charitable remainder trust, actually in this case, which allowed him to contribute his asset free of tax, get a significant tax deduction at the time they made their contribution, receive income from the full value, which was reinvested appropriately, and pay tax on that. But the deduction of the charitable deduction on taxes mean that his tax generated by that transfer was significantly mitigated. What we achieved was a number of important things, and here they are. Number one, diversification of a concentrated holding. Number two, diversification into a group of portfolios that were much more secure and suitable to his condition than was previously the case. Number three, at the end of the day, a nice contribution to charity. Number four, a significant tax deduction now to offset taxable income. And finally, he had the whole principle to invest without taking, as a California resident, virtually a 40% haircut on tax because the assets he was selling had no basis. So a charitable remainder trust worked really well in that situation. There are also alternative variations of that, the charitable lead trust, where the charity gets the money first and the family gets the money at the end. Those all depend on the family's philanthropic desires. We have the opportunity to do what's called an intentionally defective grantor trust. This is a strategy where you can, using very little of your gift tax exemption, as little as 10% of the value, and keep in mind it's a reduced value, as little as 10% can be used as the down payment on a strategy where you sell your asset to a suitably constructed trust. Put down you take back a note, and you get back a very limited amount of money in exchange. And without getting into specifics, over time, the cash flow continues to come to the person who did the gift into this trust, who made the donation into the trust. The assets stay out of the estate. We use a very low interest rate for payout, and the rest is principal payout, so that we reduce the remainder of the note very aggressively during the remaining life of the settlor of that trust, creating a terrific opportunity for retention of cash flow and then also the retention of cash flow, and also the transfer out of the assets, reducing your trying to get going. I see. I think I might be on. It's possible. Reducing your ability, reducing your estate. And estate tax is high, and it's going up in all likelihood. Bear in mind, the exemption is scheduled to end. So this is not prophecy or forecasting. The current exemptions are scheduled to end and revert in about 2 years. And so we're very much in favor of taking advantage of that as soon as possible. The remaining thing I wanted to talk about is that what's gone away is the IRA stretch. Now, a classic strategy, and you may still have it, in fact, if you're not very aggressive in your changes, if you have a significant IRA, it should already be in stretch mode, which means leaving it to a very young group of beneficiaries so that it will be stretched out over their lives in terms of distribution. That's pretty much ended now as a result of what they call the quote-unquote Secure Act past the beginning of the year. And so there are some alternatives. If your beneficiaries of your IRA currently are young members of the family or trusts set up for them, you need to reconsider that now, and there are several options. You might think about leaving it to your spouse, which is a fairly decent option now, but there are some others, including converting it into a Roth IRA, all or part, which is an interesting one, a very interesting one. The other one is setting it up as the beneficiary to be the charitable remainder trust, which is another interesting one, so that your trust can direct cash on after your death, and that charitable remainder trust would be a tax efficient vehicle as the beneficiary, and pay it out over the life, over an extended period of time, and at that time also with very low tax rates. And you can choose the beneficiaries who are going to be getting that distribution after your death, and make sure that it goes to low marginal tax beneficiaries. So there's a lot of planning opportunity. I think the board is filled with ideas, and of course it's a question of tailoring and monitoring each individual situation. The goal here, as I said earlier, be aware that there are pitfalls, opportunities. The laws have changed, values are depressed, interest rates are low, and those present a unique opportunity for all, but especially for affluent. And with that, I would like to hand over now to the BlackRock team. I think we're starting with Mark Peterson. We wanted to thank you, the BlackRock team. We're honored. RVW is honored to be associated with an institution of your stature. You bring honor to us, and your programs are terrific. We're proud to include them in many of the portfolios we design. We regard you as a source of wisdom and insight, and we're grateful to you for taking time out of your crazy days these days, because who of us don't have them, to spend time and share your wisdom with us. And with that, I give you over to Mark Peterson. Thank you.
Yeah, thanks. Great information. Thanks for having BlackRock on. Thought I'd highlight some information on the markets. Obviously been a rough stretch here. Got a couple of slides for you that hopefully you can see as well. But let's just start. The volatility has been extreme. We all know, really unprecedented in the marketplace. We had a stretch last week where we had 8 consecutive days where the market was up or down 4% or more, which was actually a new market record. Even going back to November of 1929, the previous record was only 6 consecutive days of a plus or minus 4% move. So think about that. That 29 stretch certainly was quite challenging. Even 2008 in the financial crisis, we had 4 days that were plus or minus 4% in a row. So I think that historical perspective is pretty shocking when you think about the volatility, and that's clearly been the defining feature of the event here. And I think we all know when you see these volatile periods historically, it's all around the market trying to digest the economic impact. What's the impact on companies, on earnings, et cetera? And I think the speed, the depth of the decline really reflected the uncertainty that came from the virus, and I think still exists to some degree. I think Selwyn made a great point just about the market. I think did turn a little bit as the conversation changed earlier this week around really the virus and the impact, but also when we're going to come out. I think that just was a critical turning point. We needed that shift in focus from just the virus itself to when we're going to come out. and I think that's really helped the rebound here the last couple of days. Tuesday was the third best day since 1950. And we've actually had, we're up slightly yesterday and in line for a nice day today. I think some of that probably is some rebalancing activity, obviously coming up on quarter end. And after such a dramatic decline earlier this year, I think, earlier this month, and at the end of February, everybody was in line to rebalance a little bit here. And I think folks just trying to get in front of that here the last couple of days. So sprinkle that in with the good news in regard to the stimulus and the change in conversation. I think that's changed the tone of the market a little bit here. Doesn't mean that it's the absolute bottom. Obviously, we'd never try to call that perfectly. Nobody ever does. But I think at least it's good to see the market get its feet a little bit, especially on the bond market side. I think that was probably one of the concerning things last week. The bond market activity and pricing and trading just seems very abnormal, which I think we saw in 2008 can really drag the equity markets lower. Very hard to get any kind of sustained equity market rebound when the bond market's acting irrationally. So that's the broad overview. I thought I'd just share some slides with you. This is something that we do on a monthly basis, just some observations about the market, really leaning on history. It's the old Mark Twain. History doesn't repeat, but it often rhymes. And we certainly can do that for this crisis as well. And we just wanted to pull out some of the worst days and weeks and months historically, just to get a better feel for what we're talking about. Of course, this last month or so, we've had 3 of the worst days since 1950. These are the top 15, just arbitrarily picking the top 15. But it does pull in a nice smattering of different time periods here. Of course, 87 at the top. And 2008, you have a lot of entries there, but you also pick up some good markets, 97, 98, 2011. So it's not always a bear market where you see some of these worst days historically. 62 as well is in there. So a really good sample size of a lot of different periods here. And you can see what happens 1 year after. Right, 1 year after, the market's up about 24%, which is certainly encouraging. When we zoom out and not obsess about some of these given days, I think we all realize that some of these periods led to better markets on the other side. We also did weeks and months, similar story here. Returns do change a little bit. We're on pace for the second worst month. I guess we'll probably be counting today. Will be a little bit below the second worst month. We've had 3 of the worst weeks on record historically here. And you can see some of these weeks actually are negative 1 year later, but some of these are back to back with other worse weeks. So some of the second weeks actually were positive. So if you look at even periods like in 87, I think we all forget that one of the worst weeks prior to Black Monday was actually that October 11th of 1987. But following that next worst week, or that Black Monday week of October 19th, 1987, you can see what the market did. It was up 23% 1 year later. So again, good to lean on history here, just as we find our feet with the market. And we did that throughout this month's version of this piece. Not to get into too much detail here, because certainly this isn't pretty to look at. But just did you want to give you a little bit more detail on some of the historic bear markets since 1950, just the number of the depth of the decline, how long it took to get there. Some of those details can be found here, and of course a bull market rebound. Probably most importantly, you can see if you had perfect timing, if you knew exactly when the bear bottom, which nobody ever does, you were up about 35% over the next 12 months, over 13 bear periods that we identified over this stretch. And you can see the time to break even as well. So and the 1, 3, 5, and 10, just a good historical information again to reference as we're walking through this crisis. Probably one of the big things that we run into now is just folks concerned about missing bottom. Right, whether this week is a low or not so sure. But we did want to go back in time and look at what would have happened had you been a couple weeks early, a couple weeks late. You can still see the excellent returns historically. certainly take a little bit of haircut versus that perfect timing scenario that never seems possible, but you can still see the returns. If you were 2 weeks early, 2 weeks late, well over 20% over the next 12 months over these bear market stretches. So for us, for folks who are thinking about rebalancing, I think that's encouraging. I think too often times when folks get fearful, right, you want to hope that the signal and the all clear is there, which never comes, especially even if you're even doing a partial rebalance. But I think we just need to remind ourselves that getting the bottom is not necessary here. Sometimes putting the money to work after such a steep decline in a bear market works out pretty well when you look back historically. Also added some recession information. Obviously, we're in the camp now, and you touched on the unemployment numbers earlier today. So clearly that's going to be a challenge. Hopefully one of the shorter ones we've had historically. I think you see here on the right side of the slide just the length of some of the economic recessions historically. Averages a little bit more than a year, but it can be as short as 6 months, and this one might even challenge that shortness. I think the strength and the momentum we had going into this might help a little bit more than folks realize. I think as we get back up and restart, hopefully that will help from a momentum standpoint. One thing I'll mention just on a diversified portfolio standpoint, let me see if I can share my slides again here, is we've been talking to a lot of folks, just reminding them about the diversified portfolio still making sense. What we've seen, it certainly hasn't been perfect every day in the marketplace so far, but if you look at the diversified portfolio, it has held up pretty well so far. Let me just try to find the slide here. And I think it's good to remind ourselves at this point of the cycle of that reality. And this is kind of a completely opposite reality than what we saw coming into this crisis, right? We had 11-year bull market, one of the longer bull markets in history, and we were trying to remind folks that, hey, diversification still makes sense over the longer cycle. That was the bigger challenge, and it was such a big challenge, we actually called it S&P envy. We actually created a name for it, where even some of the best asset allocators we work with across the globe were having the challenge that looking at the overall U.S. market, then they looked at their diversified portfolio mix, no matter what it looked like. There was a pretty big gap there, right? So it was just natural for folks to question whether the diversified portfolio made sense, if it needed changes, a new approach, whatever the thought might be. But for us, this is a good illustration of why we still think it makes a lot of sense. Just comparing a simple diversified portfolio, I know everybody else has a much more sophisticated allocation than this, but just a good core allocation of roughly 60% stocks, 40% bonds. And you can see what it's done over the last 2 bear and bull market cycles here. And I apologize for the fancy emojis there. But this is the challenge that we see with a lot of folks, even again, some of the best asset allocators, endowments, foundations that we work with, right? It's still emotionally and behaviorally challenging, even for professionals, to ride this cycle and not to question the diversified portfolio. I always joke with folks that you have a well-diversified portfolio if it never feels good. And that's what we see on this chart. Just looking at the last 2 bear and bull markets, we did overlay the performance here through last week of 2020. You can see the diversified portfolios held up better, but still painful to be down almost 20%. And you can see that emotionally is challenging, especially at folks who aren't quite as sophisticated. But what, of course, the punchline here is the diversified portfolio actually wins over this entire stretch, even though it doesn't feel like it along the way. So I think even for folks who get this story, I always think it's a good reminder, especially coming off that, look at that 2009 to 2019 period where you had the diversified portfolio trail by almost 160%. Certainly that left folks feeling like they wanted to take a little bit more risk, right? That was the ultimate trap, is that you ended up taking a little bit more risk because you felt like that gap was too wide. But I think we all know the reality here that the biggest impact on the outcome is doing better in difficult markets like we're seeing today. That's just something that we try to live and breathe here at BlackRock. We call it the old winning more by losing less. And I know we all know that story here on this call, but just even for professionals, I think it's great to remind ourselves of this reality and how it can play out over longer periods of time. So certainly we've tried to do that with a lot of our clients and even some of the best asset allocators that we work with across the globe. So why don't I stop there, see if there's any questions, thoughts, or comments.
I think you should keep going.
From everybody.
You're doing really, really well. Anyone who has questions, please email them in to my father, Selwyn Gerber, sg@rvwwealth.com, and we'll try and address some of them at the end. But Mark, you're doing great. Thank you.
I guess one thing I didn't mention is, we can talk a little bit about what we like coming out of this. I think historically you look at what does well coming out of bear markets. It tends to be a lot of beta, but I think that is a little bit of the trap that we see in portfolios across the country. It is the fixed income side is going to be really challenged, right? You're talking 80 basis points on a 10-year treasury coming out of this. So I think there's going to be a big move to try to revamp and rethink fixed income a little bit. But there's only so much we can do on the fixed income side there. You're still going to need to have fixed income for ballast and diversification purposes in a portfolio. But given those low yields, you're just not going to get that diversification benefit that we do when yields are higher, 5, 6, 7% historically. So I think one of that reality is you're going to need to do more with other parts of your portfolio. You can't just completely revamp fixed income. There's only so much we can do there. I think it's going to be all about doing other, revamping and rethinking other parts of the portfolio as well. I think the inclination for a lot of folks is that on the rebound side, you always want to get as much beta exposure as possible. But I think we saw on the diversification chart, it's really not about squeezing every last nickel, dime, quarter out of the bull market upside, whether it's a bull market upside or a bull market rebound. You just don't need to get all that upside. So, quality companies we still think makes a ton of sense.
Hey, Mark,
quality for us.
Hey, Mark, on the quality note, obviously one of the funds that we like to use that are very rules-based methodology that really focuses on companies with, let's say, low financial leverage, stable year-over-year earnings. Can you just talk about some of those factors a little bit more? Because those are some of the, again, rules-based methodologies that we really like.
Yeah, no, exactly. You hit all of them, right? Quality currently is in favor. We've held up a little bit better, right? Everything's kind of sold off. You've seen it with minimum volatility. Quality's done a little bit better than the overall market during this downturn, but it's everything that you touched on. Right, return on equity, earnings consistency, low debt, all those things are things that we look for. And I think it wouldn't be a shock to anybody that if that holds up pretty well coming out of this crisis. Again, it might not be the best performer just because I think you've seen some areas that have been so beaten up here, especially some of the higher beta small cap names have really gotten chewed up in this crisis. So you might see a bounce there. But again, for us, it's not about squeezing every last nickel, dime, quarter out of this rebound. We think quality makes a ton of sense coming out of this. It'll hold up better. And that's the type of revamping that I think that needs to happen in portfolios. I think in general, when we look across portfolios, and again, some of the best asset allocators we work with, some of the challenges that their equity side is too risky, especially given the lack of flexibility that low yields provide us on the fixed income side. I think we just need to embrace some more flexible approaches, some other factors like quality that'll help bring risk down a little bit on the equity side as well, and help us during periods like this going forward. I think too often times we just think about getting market exposure, getting beta exposure. But again, I think just getting a good chunk of that upside of what the bull market gives us and doing a better job in the downside is so important. It's always important, but I think it's going to be it's even more heightened when bonds aren't that easy trade that they were for 20 years, right? Or 40 years, let's even call it, right? When yields were 5, 10%. When yields are low, we're just going to have to utilize more levers in the portfolio. And I think, certainly you folks were ahead of the game here a little bit with factors like quality. But I think that's one of the keys for us going forward is evolving other parts of the portfolio, whether it's equities, alternatives fit that bill as well. But I think all those things will add up to a better way to approach the market going forward.
Thank you very much, Mark. It wouldn't be a complete RVW Wealth presentation if I didn't show you my absolute most favorite slide. And I just want to take a moment to explain what we're looking at here. We're looking at intra-year declines versus calendar year returns from 1980 to 2019. And it is so important to review this regularly as an equity investor. So what I'd like to do is show you, let me explain what we're looking at here. What we're looking at here is the blue line is the growth and sometimes the decline of the S&P 500 in each year. So you can see that in 1980, for example, the S&P grew by 26%, 81 declined by 10, 82 by 15, and so on and so forth. The average of that period is about 9%. That's what the S&P did during this period on average. But what's really fascinating is the intra-year decline, the drop from peak to trough during the year for a moment of time in each year. And it's really fascinating to look at that statistic. So focusing again on 1980, although I said the S&P delivered 26% for the full year, there was a moment in time when the S&P 500 dropped by 17%. And if you had reacted, turned to your spouse, partner, us as advisors and said, I've had enough, I can't handle it, you would have turned that theoretical, ephemeral, passing loss into a real, manifest, potentially non-recoverable loss of 17%. But if you had stayed the course and remained disciplined and stuck to the plan, you would have come to December 31st as the ball dropped and as you clanked your champagne flute, celebrating a 26% year. And in each year, virtually, you have catastrophic intra-year declines. The average intra-year decline for the S&P 500 during the same period is 14%. The way I look at this is in order to enjoy the 9% growth of this index over time, you had to have been willing to endure a 14% drop in each year. And a 20% decline we experienced as recently as 2018. And no one remembers that because it was sort of slower and steadier, not as rapid a drop as we've experienced over the last couple of weeks. But the fact is, the intra-year decline we've experienced this year we've seen that many times over this 40-year period. I'm going to turn it back over to my father to wrap things up.
So first of all, this is one of our favorite slides, and I always use the opportunity. Watching the stock market is like a man walking up the stairs with a yo-yo in his hand. The key is to watch the feet and not the yo-yo. Many people have said the best thing you can do with your statements when you get them from your advisor is stick them in the drawer. Because if the plan was done right, and that's where it starts, the plan was done right, and the implementation was done right, then the market's price is irrelevant. I just want to tell you one of the great wisdom, wise insights of Warren Buffett, who's one of our heroes. We sit on the shoulders of about a dozen giants, and Buffett is clearly one of them. And he quotes his teacher, Ben Graham, who says, when you invest in quality equities, it's as if you were in partnership with a mythic character, a bipolar fellow who is prone to severe mood swings. And there are periods when he goes through big ups and big downs. And every morning, this fellow, this mythical character, knocks on your window and tells you what he's willing to pay you for your share of the business you own. And by the way, I want you to know that we do think of ourselves as owners of fractional interests of businesses. We don't think of ourselves as, trading pieces of paper frenetically in stock market environment. So when your partner knocks on your door, this mythical fellow, if he's in an up mood, feeling optimistic and happy, he'll offer you an outrageously high price for your share of the business. We call that a bull market. And then he goes through periods of being down, forlorn, and depressed. And during those times when he knocks on your window to make an offer for your share of the business, it's a pittance of the true value. And here comes the wisdom with which I will leave you. Our job as investors is to ignore those mood swings, because although in the short run, the mood swings of your partner determine the price of what you own, the value of what you own is ultimately determined by the profits earned in the businesses you own. And our job at RVW is to focus on the profits. People have asked, what do you do in bad times? And our answer to them is absolutely nothing different from what we do in bull markets, because everything takes place right up front in the beginning when the plan is designed and the portfolio is designed to reflect the needs for income, for growth, for safety of the individual investor, and then to make modifications to that plan in response to the changing situations of the client and not to the vagaries of market prices. And our portfolios are designed in such a way that we think of them as Darwinian models of equities. In other words, our portfolios are designed so that over time, because of the organic nature, the Darwinian nature of how our equity selections are made, we're always aiming to overweight towards the best performing companies, whatever they happen to be at that point in time, and to underweight the worst performing companies as they evolve, because companies are no longer evergreens. We cannot invest in a group of companies and expect to put them in the drawer for our grandchildren. The world is too dynamic. Companies are too changing. And as someone who comes from South Africa and has been on safari many times, the image I keep in my mind always is when you watch a herd of animals migrating, the best animals, the most genetically perfect, are at the front of the herd, leading the pack. And as we move further and further towards the back, we get what they call in the army, the sick, lame, and lazy. Those are the people who are not up in the front. And those are the animals in the herd that are ultimately going to be eaten by the predators following them. The business world works exactly the same way. There are businesses now that you know are at the front of the pack. You know that. And they're staying at the front of the pack. But eventually, they too will begin to drift towards the middle and then go out and be eaten by the animals behind them. And you know companies that are teetering at the back, about to be eaten right now. Our focus at RVW is simply to ensure that we are way overweighted towards the companies in the front of the pack in a dynamic, internal, tax-efficient, low-cost way, because at the end of the day, we're a bunch of accountants running the show. And our focus is on numbers, on data, on financial statements, on profitability, and we run away from the frenzy. Our focus is focusing on facts and not on frenzy. Thank you very much.
Thank you very much, Mark, and for your team at BlackRock for supporting us and our clients. We're obviously available for questions. Please, again, email us, and we'll gladly respond in due time. Have a great day. Thank you very, very much.